to take certain required minimum distributions from that anyway. You know, can I do something with that? And the answer is yes. And with this extension, this is yet a great additional arrow. It's not a new arrow because it's been extended, but it's a great additional arrow in anyone's gifting quiver, if you will.
Let me see what it would be.
So it's a nice opportunity. It's you know, we don't get these things all that often, and we're thrilled, of course, that it's extended, even though it's only for 1 year. So then we have estate distributions from retirement assets. And these are assets that are called income in respect of the decedent. They're sometimes called IRD assets. There are things like savings bonds, individual retirement accounts, deferred compensation, 401k assets. These things don't die when we die. They move on through our estate somewhere because they're actually assets that are owned by. They're not like term life insurance. When term life insurance ends, it's over. That's it. It's done. So, as I say, they don't die. They move along. They could be in somebody's estate. And so we need to think about a few facts about these IRA accounts as how they might affect our estate situation, rather than just our annual giving situation. What we've been talking about is annual giving, but what about the estate situation? That becomes important with folks like the folks who live here at Fleet Landing, because it's older folks, their birth certificates are going to mature, you know, not that far down the road. We hope a ways down the road, but not that far down the road. This is an interesting fact. At the end of 2010, IRA and other qualified retirement plans totaled almost $17.5 trillion in the United States. That represents almost 37% of all household assets in America. That's a huge number. That number is actually bigger than our entire national debt, which I think is around 16 trillion or something, also a huge number. But these assets represent a lot of people have it. Think about it, $17.5 trillion. There's a lot of them out there. What an opportunity that is, and what the possibility is. But these are also assets that can face double, and in a few cases triple, taxation. So people who transfer these assets to their children are going to subject them to income taxes. In some cases, they may be subject to the decedent, the person who dies, to estate taxes. Now we know that a lot of people are not going to pay any estate tax because the threshold is now $5.12 million. So a lot of estates are smaller than $5.12 trillion, so this isn't really applicable to them. But let's say it was somebody like George Steinbrenner, who, when he died in 2010, had an estate of over $2 billion. He was subject to significant estate tax. And if he had a lot of IRA accounts, for example, in his estate, they could be very much subject to the estate tax. And so he would have been wise, and maybe he did. We don't really have any idea how his estate played out. But these assets could have been subject to some estate tax, which would have greatly reduced the value of his estate. Now, fortunate for him, he died in 2010. And the unique thing about 2010 is there was no estate tax in 2010. So this really didn't apply.
To do this, would the arrangements have to have been made by the living person before he died, or?
Yes. Yes.
It went into the estate?
Yes.
You can't change it?
Got to be part of the estate plan.
Okay.
Yeah. But what she's saying is if the person dies, can their children or their executor of their estate move it to a charity at that time? Or does it have to be done before death?
It has to be done. That would have to be done before death.
Okay. You mean it has to be on paper that it's going to happen upon death?
Yeah.
And as long as it's set out, then the kids can get it moved, but they can't make the decision to move it.
What you don't want to do is you don't want to have it go to the kids. If you have, let's say, 2 or 3 different assets, the dangerous asset is that one that they could be subject to have some income tax. Why move that? Move another asset to the children that isn't going to be subject to that. And use the IRA assets or the Roth IRA assets in your gifting plan. And that's really what the situation is, because you can avoid potentially some double taxation. Some people may end up with having to pay some estate tax on it, and then the kids end up paying income tax on it. Both of those events reduce the value of that IRA account. So IRA accounts are an important asset to consider in estate planning as well, beyond just what we can do in 2013 as our annual gifting plan. It's got some estate consequences that are important to consider. So direct distributions from IRA accounts to qualified charities. The law that made this gifting opportunity possible, now we know, is extended through December of 2013. This is a little example of this sort of double taxation. And the idea is not really to sort of get into the math, because it changes depending upon one's situation. But if you take, for example, someone who has an estate tax, which is now 40% once you've reached the threshold. So 40%, assuming that someone has reached that threshold and they have $100,000 in an IRA, 40% of it goes to the estate tax. So that $100,000 is reduced by $40,000, bing, right away. So if you could have done something in your planning ahead of time, you could have saved $40,000 for your heirs, or done something else with it that might have made you happy, taking care of a charitable organization that you cared about. Children, let's assume in this case a child, just say it's one child, and they're in 25% tax bracket. Now they've got this IRA, and that IRA is going to earn income, and that income is going to be taxable based upon their tax bracket. So 25% of that amount of money becomes $15,000. So really, right under the gun, the potential is that $55,000 of that original $100,000 can be lost to taxes. Again, depending upon one's situation. The point here isn't really the mathematics, the point is the idea that there's two kinds of taxes here that could be affecting this IRA, this asset that one has. So it could be worse. There's all kinds of discussion. The rhetoric in Washington is far from over. We're going to hear a lot more about it. There's going to be all kinds of things with not the fiscal cliff, but the debt in trying to find other ways to create revenue and cut expenses and so on. The current law allows a child to pay income tax on, let's say that in that previous slide, ratably over the child's lifetime. That's okay, that's reasonable. It's kind of like when we have a charitable gift annuity and there's a capital gain, we use stock to fund that gift annuity. That capital gain tax can be paid ratably over the actuarial life of the annuity. That's pretty good. The Senate Finance Committee is still considering changing the rules to accelerate that income to 5 years instead of ratably over a lifetime. So that means that that's worse for the child. That means they got to pay all that income tax in 5 years. Got to calculate it out and pay it in 5 years. You know, do we want to do that to our children? Is that really what we want to do in our estate plan, is create a nice fat tax liability for our kids? And
Plus it will jack up their income.
It'll jack up their income, and they're going to have to pay the tax quicker. So this is not the law now, but you know, we've got a Congress and we've got a government and we've got a lot of debt, and they're looking at ways to try to raise money. Here's a neat little way that they could raise approximately $4.6 billion. So this is the kind of talk that's going on. This is the kind of thing that we're thinking about. This is the kind of thing that makes considering using IRA assets in a gifting plan more attractive. So what are some of the estate planning gift options? There are a couple, and they're good ones. Individuals can bequeath in their will these assets to their favorite charitable organization, thereby keeping less tax disadvantaged assets for transfer to their family. Because we've now identified that IRA accounts and Roth IRA accounts really, from a tax standpoint, are a disadvantaged asset as opposed to other kinds of assets. So when one is doing their will or updating their will, and there's going to be a lot of that going on because of these new tax law changes, people are going to be taking a look at their wills and their their trusts and what can we do. They may want to consider saying, hey, I want to give to charity A, charity B, charity C, why don't I use my IRA account for some of that gifting? It's easily done. The process is simple. It's simply getting a transfer form completed. If you're married, you need both spouses to complete it. It's one of the things, Karen, you and I have learned. Need to be signed by both, because if you're filing joint returns and the assets are equally owned, that beneficiary designation is all that needs to be done. It's usually a one-page document. It's signed with the person who actually owns that account, the administrator of that account. So that's one way to move it out of your estate. It's fairly simple in an estate plan within your will, and simply filling out beneficiary designation. I designate Fleet Landing 50% of my IRA and Baptist Health for 50% of my IRA. Would be a very simple thing to do. Another option is to consider a charitable remainder trust. Now these would be for folks that probably have fairly significant IRAs. And there are lots of people that have IRA accounts that are in the millions of dollars. It had been reported that it's tens of millions of dollars that then President-elect Mitt Romney has in IRA accounts. What's he going to do with those? How's that going to affect his estate? So an individual could leave these assets, specifically bequeathing them to fund, when they die, it would fund a charitable remainder trust. And that charitable remainder trust would pay income to beneficiaries for the lifetime of those beneficiaries. It might be a son, it might be a daughter, it might be children. And when those children die, the charitable remainder, what's left in that trust, which was funded by IRA accounts, then goes to, let's say, Fleet Landing and or Baptist Health for the sake of conversation. So there's two neat options you can do in estate planning for that. Simple beneficiary designation. 2, set up a charitable remainder trust, fund it when you die. Can't fund it before, it comes into being when you die. And then the income for that is paid at whatever the rate of that trust is to beneficiaries, taxable beneficiaries, usually children or grandchildren. And then when they pass on, the remainder interest goes to the charitable organization. So that's another option of what can be done. Most importantly, and we say this literally anytime we give any kind of a seminar or have any kind of a discussion, is talk to your financial, your tax, your estate planning advisors. In any of these kinds of decisions, it's very important to have their input, have them understand what it is you're thinking you'd like to do, get their input as to how to do it, make sure that the rules are being followed. Let them know that you understand that there are opportunities to do some creative things with IRA and Roth assets that you might not be able to do with other kinds of assets under the rules that we currently have. So we always recommend talk to your advisors. We have a list of sources that we use. Somehow or other this list gets longer every time we do one of these. But we feel fortunate. We have a number of really good resources that we rely on. There are folks who testify in Congress that are counselors and are very steeped in gift planning. There are banks. There's a lot of different resources here that we use, that we try to collate and bring information together so that we can present it in sort of real English and layman's terms to help people understand what those opportunities are. We also have this little thing called Disclosure 230. I'm not going to read it to you. This is sort of the legalese of the U.S. Treasury, and the great disclaimer that no matter what you do, we're not going to take any liability for what you do. And it's just one of those things. It's getting more complicated today, and you have to have these disclosures. It's really no different than under the Philanthropy Protection Act of 1995, when an organization who offers charitable gift annuities, they must present their donors for every gift annuity with a disclosure statement that has certain information about those gift annuities and what the reserve funds are and so on. This is nothing more than a disclosure statement that says there's certain things about this information that we strongly urge you to talk to your advisors about that. So with that, questions?
You've kind of covered a lot of them along the way.
It's an interesting topic, it's an interesting opportunity, they're interesting assets by themselves. They're different than stocks and bonds and cash. Those are still very relatively easy. Our good Congress may come up with all kinds of schemes and ideas, and Lord knows where they'll go, as to how they could garner some more revenue from those assets. There's also a great deal of talk in Congress right now, and there's going to be more, we're going to be reading more and more and more about it, about the very nature of the charitable deduction. It is going to be under attack. Will Congress put limits, more limits, on how much people can deduct for charitable purposes? There'll be very strong opposition to that. The not-for-profit sector is a huge, huge industry in America. But if you're a congressperson, you're looking at that and thinking, that's one of those government expenditures, and how can we get more revenue from it? And as we know, they're talking about the big three, Medicare and Social Security and Medicaid. They're talking about all kinds of tax deductions. They're even talking about the mortgage deduction. These are things that are fundamental to our culture. The American dream of owning a house and the mortgage deduction. Most of us, when we bought our first house, we didn't pay cash for it. We took a mortgage and we were able to take a deduction for the interest payments on that mortgage. The same is true with the charitable deduction. It's been around since 1917. It's part of our culture. We don't want to lose that. So there's a very strong lobby against that. So there's going to be lots going on. In the meantime, it's incumbent upon us to keep up to date on all of these topics and be able to properly provide information to our donors and our prospective donors to help them in their planning decisions.
I've got one more question.
Okay.
Could you just touch briefly on how the income, the IRA transfer could affect your income for tax purposes that we discussed earlier?
The transfer, the direct transfer from an IRA to a charitable organization does not create an income tax liability. It's not includable in your income that would be taxable. That's one of the nice advantages of it. So let's say you transferred $10,000 directly from your IRA administrator to Fleet Landing. That's not an income taxable event for you.
But it doesn't affect my income either, my adjusted income.
No, it's not added to your income.
Added to your income,
that would be
so
taxable.
it wouldn't affect Medicare.
I don't know what its effect on Medicare is.
Okay.
That's a good question, and particularly with the new 3.8% Medicare tax that took effect on January 1st, and its purpose is to be used towards funding the Affordable Care Act, the healthcare law. What the effect of that is on that, I'm not exactly sure, but I don't think, it doesn't add to your income. So my belief is, and again, this is one of those things where you want to be sure with your advisors that because you don't have an income tax event, you want to make sure that you don't have to pay 3.8% on that as well. I don't believe you do, but it's one of those questions where you want to check with your advisors.
Well, doesn't the 3.8 kick in at an income level, at a higher income
Yes, and
level?
it has to do with investment income particularly, and there's all kinds of rules, and we're just beginning to sort of study and figure out how that goes. We're actually going to do a write-up on that specifically and try to write it in English terms that people can understand, and when we do that, we're going to have that available for you folks as well.
No, along the lines of what Olivia asked, if you take IRA money and transfer it to a Roth, okay, I take IRA money and put it in a Roth IRA, I pay taxes on it, and it adds to my taxable income. Okay, it does, but what he's saying is, if the IRA goes directly to Fleet Landing, never mind the Roth, goes directly to Fleet Landing, it does not add to your taxable income.
It's not a direct distribution
Direct distribution.
from the Roth or the IRA to Fleet Landing in 2013 is not an income taxable event for you.
Mhm.
But you also don't get a tax deduction. That the two wash each other out. That's correct.
I guess the Roth is tax-paid money?
It's after-tax money when it goes in.
Yeah.
It's after tax, it's
Right.
tax-paid,
Right.
so why wouldn't you get a deduction?
Because the IRS doesn't allow it.
And what's the advantage, I guess, from going from an IRA to a Roth?
Because
Well-
your money's, once your money is in the Roth, there's no required minimum distribution going down the road,
I
Right.
see.
and you're not,
Right.
you're not taxed.
And there's that additional
It's paid to.
advantage that we discussed earlier, where you now have an expanded, with fewer limitations, opportunity to make a transfer from 401k to Roth.
Right.
That has been expanded with less impediments to it.
Okay,
Once it's in the Roth,
yeah,
in 2013, you can make a direct distribution from that Roth
mm-hmm,
to a qualified charitable organization. So what that does is it opens up a new opportunity in a sort of a two-step process for gifting that you didn't have before. So it does have a little bit, that's an expanded advantage that can happen. So there's some really interesting, this is actually from a charitable standpoint, this is the most interesting thing that's happened in the American Taxpayer Relief Act of 2012. And it was one of the early, when you looked at the Federal Register and you started reading the text, it's interesting, it's one of the first of the list of extenders that was listed.
Oh, yeah?
And there was a whole list of extenders, most of which had nothing to do with charitable giving. But what that says to us is there has been lots of discussion, lots of effort to try to extend that IRA gifting option. And so it was included in the extenders, and of course we're thrilled about that, because that's a nice opportunity for a lot of folks.
So, on the Roth, I guess, people below 70, below some number, can't make withdrawals.
Within the Roth.
right.
Yeah, and I'm not exactly familiar in detail what those rules are, what those age limits are, and those kinds of things on the Roth side. On the IRA side, it's 70 1/2.
The Roth, you have to have it for 5 years before you can pull it out.
So the Roth,
Certain monies.
Yeah, the big money in America is not in the Roths, it's in the
I'm
IRAs.
just saying that taking out the Roth is a new thing.
But you could do it before, Richard. You could make but it was limited. You had to meet certain requirements to be able to use to be able to go from like a 401k to a Roth. That was limited. That's now been expanded. It's easier to do that now, as long as that opportunity is listed in your 401k plan. But the big opportunity, we see many, many more distributions directly going from IRA accounts than we see from Roth IRA accounts. Because there's a lot more money in simple IRA accounts.
Well, and you don't have that advantage of it being, you'd get if you use money from a Roth, you would get a charitable deduction because you've already paid the tax on it.
I'm not positive about that.
Okay.
I'm not exactly.
But you don't, but you don't necessarily get that wash either.
No.
So
In
then-
IRA, it's a wash. You know, no
Right.
charitable deduction, but also no income tax. So it's not includable in your income. So we've got it for 12 months and 3.5 days. And You know, we have 3.5 days if somebody wanted to do something and had it count in 2012, they can do that. They've got 3.5 days left to do it. Or if they took a distribution in December 2012 and would now like to write a check from that distribution to Fleet Landing and then elect to use that as a direct contribution from an IRA account and have it countable in 2012, you can do that up until through January 31st. It's a very tiny window, really tiny window. But that was the way under this law that they were able to say in the law that the law extender covers 2012 and covers all of 2013. But they gave you a limited opportunity to make it happen for 2012. But for some people who really like giving that way, let's say you were a very wealthy person and you wanted to give right up to the maximum, $100,000, before January 31st, you can actually do this for 2012, and then you could do it again in 2013.
200,000.
200,000 in a pretty short time. I'm saying, I qualified it, Richard. I said if you were a very wealthy person, you know, but you could do that, which is kind of, but the window is so small, you know, you'd have to, you know, let's say that you were all wealthy folks, and you all left this room and you all said, I'm going right now. I want to make that transfer right now. I better do it today. You can do that. And then you could turn around really the very next day, because we are in 2013, and you could do the second 100,000. You could literally do it at the same time. It's an election, really, to use and cover 2012.
So the first 100,000, you write the check, so that's doable in a day.
Yeah, if you took an IRA distribution in the month of December 2012.
Which is what most people do.
Which most people do.
They leave it in as long as they can leave it in.
If you took your distribution in last August, then you can't do that. You had to take it in December.
That follows your first time.
Yeah, so it's you know, that's the way the rule works. There's always something to kind of keep our juices flowing on this subject, but you know, there they are. It's a great arrow in one's quiver. There's certain benefits for this in gifting. They're not the benefits that you get from a charitable gift annuity, because those are life income kinds of gifts. But the combination of those two are very powerful gifting options that still exist, you know, in 2013.
Would that be the bridge people getting in?
So thank you for coming this morning. It's always good to do an update. We get excited when Congress does something that benefits people. This is one of those little neat things that does benefit people if they're so inclined and are generous, and fortunately we are still a very generous society.
Thank you.
And now